Welcome to More Pips Traders, a profitable Forex education platform that teaches easy ways to make profit in the Forex market. Today we are going to look at a simplified introduction to Forex trading. If you follow this lesson with me to the end, you are going to understand Forex trading. You will know why you should trade Forex. You will know the key participants in the Forex market. You are going to learn the key Forex terminologies and you are going to master how to utilize them effectively. Now, what is Forex? The word Forex is the short form for foreign exchange. And the Forex market is a global marketplace where banks, corporate organizations, as well as individuals speculate on the exchange rate between currencies. These currencies are divided into major currencies and minor currencies. The major currencies are the frequently traded currencies like the USD, Euro, JPY, GBP, CHF, CAD, NZD, and AUD, while other currencies are referred to as minor currencies. The Forex market is by far the largest financial market in the world. However, there are other financial markets like the stock market. Also, currencies are not the only instruments traded in the Forex market. Other instruments like metals, oil, crypto, and many others are traded in the Forex market. Now we have mentioned that currencies are traded in the Forex market. It is very important to note that these currencies are traded in pairs. These currencies are traded in pairs. And in every currency pair, there is a base currency and a quote currency. The first currency in the pair is known as the base currency, while the second currency in the pair is known as the quote currency. For instance, in the table below, we have some currency pairs and their base as well as quote currencies. In the case of USD CHF, USD is the base currency, CHF is the quote currency. NZD JPY, NZD is the base currency, JPY is the quote currency. Euro GBP, Euro is the base currency, GBP is the quote currency. AUD JPY, AUD is the base currency, while JPY is the quote currency. Now let's classify the currency pairs. Currency pairs are classified into major currency pairs, minor currency pairs, and exotic currency pairs. The major currency pairs are the most traded and the most liquid currency pairs. And the key characteristics of a major currency pair is that it must have a USD in the pair. For instance, we have Euro USD, USD JPY, GBP USD, NZD USD, USD AUD, and many others. Those are examples of major currency pairs. The minor currency pairs, on the other hand, are also called cross currency pair. And the key characteristic of a minor currency pair is that it does not have USD in it. Example, we have the Euro GBP, NZD JPY, AUD CAD, GBP CAD, Euro NZD, and many others. The exotic currency pair is a currency pair in which a major currency is paired with a currency from a smaller economy. For instance, we have USD against the Turkish lira, we have the Euro against the South African rand. Those are examples of exotic currency pairs. Now that we have understood the nature of the Forex market and what is traded in the Forex market, how is Forex trading carried out? Forex trading is the simultaneous buying and selling of currencies through a broker. The simultaneous buying and selling of currencies. What that means is that you carry out the buying and the selling simultaneously. Remember that we said that the currencies are traded in pairs. Now, as a forex trader, you are speculating on the exchange rate between currencies. Either there are going to be a rise in the exchange rate, or there is going to be a fall in the exchange rate. So when you go for a buy, the exchange rate tells you the amount of the quote currency to pay in order to buy 1 unit of the base currency. On the other hand, when you go for a sell on any currency pair, the exchange rate tells you the amount of the quote currency you get for selling 1 unit of the base currency. Example, we have a currency pair here, USD CHF. The exchange rate is 1.6350. What that means is that 1 USD is worth 1.6350 CHF. So if you go for a buy of this currency pair, you are going to give out 1.6350 CHF to get 1 USD. And if you go for a sell of this currency pair, you are going to give out 1 USD to get 1.6350 CHF. What that means is that when you buy any currency pair, you are giving out the quote currency to get the base currency. And when you sell any currency pair, you are giving out the base currency to get the quote currency. Now, why should we trade forex? We have mentioned that the forex market is not the only financial market in the world. So what are the reasons why we should go for forex trading? The number one reason is there is high liquidity in the forex market, and this ensures that you can buy and sell currencies at any time with minimal price slippage. Another reason why you should go for the forex market is there is round-the-clock accessibility. The forex market is open 24 hours a day, 5 days a week, and this allows traders to adapt to their preferred time frame. You can choose your own time frame because the market is open between a wide range of time. Another reason why we should choose the forex market is because there is leverage in the forex market. You can control a larger position with small capital. So those are the key reasons why you should go for the forex market over other financial markets. Now, who are the key participants in the forex market? The number one participant in the forex market are the big banks. The big banks, they act as the market makers. They are the ones facilitating currency transactions. The next set of people in the forex market are the corporate organizations. They engage in forex trading to manage international business risks. We have the retail traders like you that go to the forex market to buy and sell currencies to make profits through a broker. Now, what is exchange rates? Exchange rate is the amount of the quote currency needed to get 1 unit of the base currency. In simple terms, the exchange rate is the price at which a trade is executed. The price at which a trade is executed is the exchange rate. Now, PIP. The word PIP stands for percentage in points, and this is the smallest unit of price for any currency pair. In every price, the fourth digit after the decimal point is the pip. Now, pipette. Pipette is 1/10 of a pip. The fifth digit after the decimal point in the price is the pipette. Lot size. Forex is traded in specific amounts called lots, which is the number of currency units you buy or sell. The number of currency units you buy or sell is the lots. Now, there are lot sizes you can trade with. We have the standard lot, which is 1 lot, and when you're trading a standard lot, you're likely to gain or lose $10 per pip. In the mini lot, which is 0.01 lot, you're trading $1 per pip. Micro lot 0.01 lot is equal to $0.1 per pip. A nano lot, which is 0.001 lot. Now, bid and ask. The bid price is the price at which the broker is willing to buy the base currency in exchange for the quote currency. That is the best available price at which you can sell to the market. The best available price at which you can sell to the market is the bid price. The ask price, on the other hand, is the price at which the broker is willing to sell the base currency in exchange for the old currency. The best available price at which you can buy from the market is the ask price. Now, the difference between the ask price and the bid price is known as the spread. The spread is the difference between the bid price and the ask price. For instance, we have mentioned that in every currency pair, there is a base currency and there is a old currency. And we also mentioned that the fourth digit after the decimal point in a price is the pip. So in the case of the bid price, we have 1 pip, and in the case of the ask price, we have 3 pips. So if spread is the difference between the bid and the ask price, if you subtract 1 pip from 3 pips, you are going to have 2 pips. So the spread for this transaction is 2 pips. Now let's look at transaction cost. Transaction cost is the spread for a round-turn trade. Round-turn trade, we are trying to say here, is from the time you enter the trade to the point you exited the trade is a turn. So the transaction cost, the spread for this transaction from when you entered to the point you exited is the transaction cost. So it's simply the monetary value of the spread. Remember, the spread is in pips. So the financial value of the number of pips, that is the spread, is equal to what? The transaction cost. And that will depend on the lot size you are trading. For instance, if you are trading 1 standard lot and the spread of the transaction is 3 pips, it means that the transaction cost is equal to what? $30. Remember, we said that in a standard lot, 1 pip is equal to $10. Now, margin. The percentage of your trading account required to service an active trade is known as the margin. And this will depend on the currency pair, the current price, and the lot size. What will determine the margin is the currency pair, the current price, and the lot size. Now, leverage. We have mentioned that as retail traders, you go into the forex market through a broker, and this broker offers leverages. So this leverage will give you the capacity to control larger trade positions with small capital because you are leveraging on your broker. Now, order types. In forex trading, there are 2 major order types. We have the market order and the pending orders. In a market order, you are trading at the current market price. You are buying or selling at the current market price. But in a pending order, you are buying or selling at a later price that you will be the one to determine. A market order is executed instantly, while a pending order is executed later when the market price gets to your stipulated price. Market orders are also known as instant execution. Like I said, market order is an order type in which you buy or sell at the market price. It is also known as instant execution. While pending orders, you buy or sell at a later price. 2 major types of pending orders: the limit orders and the stop orders. Limit orders and stop orders. In a limit order, you are either buying below the market price or selling above the market price. 2 types of limit orders are the buy limit and the sell limit. Now, in a buy limit, you are going to enter below the current market price in expectation that the price is going to fall to your entry point. And when price gets to your entry point, your trade will be activated before the market will begin to rise again. And when market rises as expected, you begin to make profit. Remember, this depends on your understanding of market analysis. When we get to market analysis, we'll go into details of how to analyze the market. For instance, let's look at this illustration. If you look at the current market price is up here, but we are entering our trade down here because we have analyzed the market and seen that the price is going to fall. So when price gets to our entry point, our trade will be activated. and when price continues to rise, we'll begin to make profits. Sell limit, on the other hand, you enter the market above the current market price in expectation that the price is going to rise, and when the price rises to your entry point, your trade will be activated before the price will begin to fall again. Remember that if price did not rise to your entry point, your trade will not be activated. Now, this is an illustration to describe all I've said. I said in a sell limit, you're placing your entry above the current market price. The current market price is around this point, and you're entering your trade around here because you are expecting this market to rise to this point. And after it has risen to this point, it will continue to fall. This, like I said, will depend on your understanding of the market analysis. Stop order. In a stop order, you buy above the market or you sell below the market price. A stop order is an order type in which you buy above the market or you sell below the market. So in a buy stop, you are placing your entry above the current market price in expectation that the price will rise and will continue to rise. For instance, let's say the current market price is here. So we are entering our trade above the current market price up here because we are expecting the price to rise and to continue to rise. So when the price rises to our entry point, our trade will be executed, and when the price continues to rise, we will begin to make profit. In a sell stop, we are selling below the current market price because we are expecting this price to fall and continue to fall. So when the price gets to our entry point, our trade will be activated, and when price continues to fall as expected, we begin to make profits. Now, stop loss. The stop loss is a point at which a losing trade closes on its own to prevent further losses. If you put a stop loss on your trade, if you're losing, you're simply saying, I should not lose beyond this point. That puts you in control of whatever you're doing. In the same vein, we have take profit. A take profit is a point at which a winning trade closes on its own to save a stipulated profit. Let's say you entered a trade and you cannot sit down to be monitoring the trade. Now, if you put your take profit, if you are winning the trade and you are specified, okay, if I win so number of pips, I will be fine. Close for me there. This take profit puts you in charge of your winning. When you have won your stipulated number of pips, the market will close on its own and your profit will be in your account. So it is very important to note these points. When we take a risk management class, we'll give you details on how to determine these points and where to put them depending on if you are going long or short on any currency pair. There are various forex centers in the world, and there are stipulated times when these forex centers opens and closes. So let's look at the first center, the Sydney session. The Sydney session opens around 10 p.m. GMT and closes around 7 a.m. GMT. The Sydney session opens between 10 p.m. to 7 a.m. GMT. That is to say that the Sydney session works between 11 p.m. to 8 a.m. West African time. Remember, West African time is GMT plus 1. The Tokyo session works between 12 a.m. and 9 a.m. GMT. That is to say, the Tokyo session works between 1 a.m. and 10 a.m. West African time. London session. The London session works between 8 a.m. and 5 p.m. GMT. 8 a.m. and 5 p.m. GMT. That is to say, it's working around 9 a.m. to 6 p.m. West African time. Now, the New York session. The New York session works between 1 p.m. to 10 p.m. GMT. 1 p.m. to 10 p.m. GMT. That is around 2 p.m. to 11 p.m. West African time. Like I said, West African time is GMT plus 1. Now, it is very important to note that there are points in time where two sessions will be working simultaneously. These points are called session overlap, when two sessions are operational simultaneous. Now, let's look at the London-New York overlap. The London-New York overlap occurs around 1 p.m. to 4 p.m. GMT, which is around 2 p.m. to 5 p.m. West African time. It is very important to note that London-New York overlap is the busiest trading period in the Forex market. This period accounts for a significant portion of the global trading volume. During this period, there is high liquidity and volatility in the market, and this provides good trading opportunities for short-term traders. The next overlap is the Sydney-Tokyo overlap. The Sydney-Tokyo overlap occurs around 12 a.m. to 6 a.m. 12 a.m. to 6 a.m. GMT, which is around 1 a.m. to 7 a.m. West African time. So far, we have gone through the simplified introduction to Forex trading. In our next class, we are going to look at how to choose a trading platform. What should you consider before you choose a platform to trade on? Do not forget to subscribe, like and share these information so that these information can as well get to other traders out there that need a well-defined pathway out of their trading confusions.